we're really going to try and make it much more interesting for you today. I'd love to share with you more about my story, but we're limited for time today. So I'll just give you a quick snapshot so you have some context. I'm a wealth management and trust professional with over 30 years experience. For more than a decade, I was the managing director of Rothschild's wealth management business here in Singapore and a director of Rothschild Trust. And it was during this time that I first started to learn that wealth is not just about money. I've now moved to the client side and I'm the managing director of a multi-family office here in Singapore, where I can be fully aligned to clients without conflicts of interest. In my view, wealth is not just about money. There are plenty of examples of wealthy families who have more than enough money. Some are even billionaires, but they're not wealthy because they're not in harmony with themselves, with their family, or with the world around them. I've always been passionate about personal development and nutrition and wellness. And I'm so excited to now be able to put all that together and help my clients holistically in wealth and succession, but also in all aspects of well-being. I'm not the only one to think like this. The legendary investor Sir John Templeton was asked, what is the secret to wealth? And his reply was, the secret to wealth is gratitude. Okay, so your return is what you get back for investing. So cash, you would get interest if you put your money in a bank. In theory, you get interest anyway, not at the moment. Interest rates are really low at the moment. But in theory, you get cash, you get interest on your cash. And you get interest on a bond. And property, most people understand, you rent a property out, you get rental income and you participate. You've either got a gain or a loss on the property value. Shares, you have a dividend, which is if the company is doing well, you might receive a dividend, which is your share of the company profits. You participate in the success or failure of that company. And when we talk about defensive and growth, I'll just say this is very simplified because you can also get bonds that are high risk. So just want to put that out there. You know, this is talking very simplistically. But traditionally, yeah, cash and bonds are more conservative or more defensive, and property and shares are your growth assets. So next slide, please. So two things I'd like you to take away from this. You can see shares, whether it's whatever market you're invested in, your return is higher than it is in cash. So that means your money's growing at a faster pace in the growth assets than they would be in the defensive assets. The second point I'd like you to have a look at is how returns in the future are expected to be less than in the past. So look at the cash rate. In the past, it was 4.5%. Going forward is expected to be 0.6 to 1.6%. The shares is also less, it's less pronounced, but it's still going to be lower going forward. So there are two important points from that. So risk and return. Yeah, you can see here that the higher return you want, the more risk you have to take. So you've got cash at the lower end, followed by bonds, property and shares. And as Molly said, the two go together. You've heard the phrase, there's no such thing as a free lunch. Well, there's no return without risk. They go together like fish and chips, or I was thinking chicken rice for our Singaporean friends. I'm sure you guys can think of your own simile and just put it in the chat box. But they go together, very closely correlated. Risk, next one, yeah, volatility. So this is an interesting chart. This shows you, the blue line shows you the Australian equity market, and the pink line is the average, the annualized return. So you can see two great big drops here in 2008 financial crisis and again in March this year. Volatility is the pace at which prices move, how widely they swing. So March, and by the way, this is Australian shares, this chart, but it wouldn't look that much different if we used any of the major markets. So in March this year, we had a major correction. And in my view, in these challenging times, it's more important than ever to have a prudent steward of your wealth. So I'd just like to share with you a quick story. It was February 2020, and I was preparing for a client meeting where I was reviewing the portfolio for the client. Now, at the time, coronavirus was mainly in China, with a few cases in Singapore, Japan, and Korea. and the markets had remained resilient through January and February. But despite this backdrop, I asked our investment team to prepare for me an analysis of how the portfolio would perform in a crisis. I know, spooky, hey? So we put together a simulation of 10 different scenarios, including the 2008 financial crisis, the 2011 Japanese earthquake, and 8 other scenarios. And what it showed us was that the prudent investment strategy that we had for the client would make the portfolio resilient, but it would lose much less than the markets in a correction. And this was eerily timed because just 3 weeks later, the market corrected 33%. So am I a fortune teller? Do I have a crystal ball? Well, not quite, but I do have 34 years experience, and I didn't know exactly when the correction was going to come, or I didn't know for sure that it would be coronavirus that would trigger it. But I did know that we were 11 years into this market rally, and it felt to me that it wasn't prudent to add more equity risk so late in the cycle. So in my view, preserving wealth, which is mostly what I do for clients, they've usually taken a lot of risk to make their money, and then they want me to preserve what they have. And in my view, preserving wealth is not whether or not there's a storm out there. We know it's stormy conditions. You can see all these risks like black clouds on the horizon. And it's also not about trying to time the market to avoid the storm, but instead it's more about building the ship sturdy enough to weather any storm. Inflation. Okay, inflation is the increase in the cost of living. So I'm sure many of you like to buy a cup of coffee on the way to the office, but look how the cost of the coffee has increased over time. From 1970, when it was 25 cents, to 2000 when it was $1, and then up to 2019 when it's $1.59. So what it means is that our money won't buy as much today as it could yesterday. So that's all very well, but I'm more interested in the future. So what does that mean for you in the future? It means if you put aside money and you say in your mind, okay, I've got enough money there to last me for 5 years in retirement. What you need to be aware of is by the time you get to retirement, that money may not last you for 5 years, not because your lifestyle has changed, but because everything costs more. It's like, imagine you're stepping onto an escalator to walk up, but the escalator that you've stepped onto is actually coming down. So if we stand still on the escalator, we're going to move backwards. So we need to walk up at a faster pace than the escalator is coming down in order to make progress and get to the top. Does that make sense? So that's inflation. Interest rates. Interest rate is just the amount of interest that you pay as a borrower or you receive as a depositor. But the challenge at the moment is that interest rates are at historical lows. In most major currencies, they're close to zero, or in some countries, even negative. So that means it's even more important that we invest our money, because if we stay in cash, it's good to have a bit of cash, especially in volatile markets or for your short-term goals, as Molly mentioned. But if you stay all in cash for a long period of time, your money will not, the value of your money will not be protected against inflation. So like on the escalator, you're going to be going backwards. And this is why cash isn't always king. So you've heard that phrase. This is why, because the cash rates are not going to keep up with inflation. Yeah. So I just want to say something that I was going to mention earlier, and that's that it's important that we remind ourselves of our value. And this ties into why women as well. So as women, we are often undervalued, either by the value that we place on ourselves or the value that other people place on us. It's very common in business to see women that undervalue their service. And unfortunately, it's also common to see women generally in life who undervalue their self-worth. As women, we play a pivotal role in the family. We're often focused on giving to everybody around us, even to the point where we have nothing left to give. We could be running on empty, and yet still we could be focusing on helping other people, and sometimes to the detriment of our own well-being. And in my view, allocating time to ourselves and allocating money to ourselves are two important ways to give ourselves the respect and the value that we deserve. And if we do this first, then when we help other people, we're doing it from a position of strength. I'm sure a long time since we've all been on an aeroplane, but aeroplanes. When you sit on the plane, the cabin crew talk to you about the safety demonstration, and they say, if there's a problem with the oxygen, the mask will drop down from above, and please put on your own mask first before helping others. So why do they say that? They say that because if you start helping other people, by the time you get to the third or fourth person, you'll start feeling weak and you may collapse. But if you put on your own mask first, you then can help so many more people for so much longer, because you're doing it from a position of strength. And I believe the same is true in life. If we take care of ourselves first, then we can help so many more people for so much longer. So when you want to invest, the first thing is to decide is how much you're going to invest.
Hi, it's Elizabeth Hart from the Life Academy. I really hope you enjoyed that video and found it helpful. If so, please give us a thumbs up and write a review. And please subscribe on the link below to join us on this journey, to grow and learn together, to live with purpose and fulfilment as the best version of ourselves. See you soon.